Markets in the green big time today, stopping a 7-day skid. Our next guest thinks market volatility is the new normal, and he has some stock picks for you to ride this roller coaster. Mark Tepper is the president of Strategic Wealth Partners. Get your picks in just a moment. Mark, first, your thoughts on today's rally. A lot of people saying it's driven by the strong consumer spending of the Black Friday and holiday shopping weekend, but you're not all that optimistic. At least you weren't before today.
Correct. Yeah. I mean, it's really tough for us to be able to compare apples to apples looking at this holiday shopping season versus last holiday shopping season so far, just because they're completely different. One of the first headline numbers that I heard was that retail sales on Black Friday were 6.6% higher this year than they were last year. And at first glance, that seems to be a pretty good number. But then I looked at it a little more closely and said, well, wait a second. Stores opened at 5 or 6 in the morning last year, and a lot of stores opened at midnight this year. So the total shopping time available to consumers on Black Friday may have increased by 20 to 30%, yet retail sales only increased by 6.6%. Now, the 16% weekend number of retail sales increase year over year seems pretty good, but there's really two main issues I have with that. Number one is how much of that was pull forward. And what I mean by that is how many of the people that went shopping at midnight on Black Friday typically would put that off and wait until maybe December 20th or so to do their shopping. Now, since they went midnight on Friday morning, they're not going to go shopping on December 20th. So we still have to see how the rest of the season plays out. Second big thing is how much of the increase in sales is going to come at the expense of margins. I saw one ad for a 42-inch flat screen TV going for $199, and I just don't see how companies can make any money selling those for $199.
Mark,
so those are my issues.
I want to know where you found that for $199. I might be a buyer.
I think it was Best Buy.
You know, talking about the stocks you like, so you don't like any retail names, but I think it's interesting too that you like Altria and Duke Energy are big-time dividend payers, especially, you know, you look at an Altria, it's yielding about 6-7% right now.
Exactly. Yeah, I mean, we're big fans of really receiving yield for our clients right now, whether it be high-yield bonds or high-yield stocks. And with the stocks in particular, I think one of the things that a lot of investors overlook is the fact that over 70% of the total returns of the stock market historically have come from dividends, not capital appreciation. Obviously, it's going to be much more glamorous to buy a stock for $2 and one day hopefully you can sell it for $100, but those are few and far between. So we like to make sure that no matter what happens throughout this period of heightened volatility, that our clients are receiving some yield.
Yield obviously makes sense, perfect strategy in these volatile times, but what do you think about outside of that strategy? Obviously, we're just coming off a very strong sell-off. Even today, there might be some bargains to be had. Anything on that front?
Right. Yeah, I mean, I guess our concern for our clients is more, I'm more concerned with where the market's going to be, I guess, 3 years from today than 3 days from today. So we still see a lot of pretty serious issues out there. You know, the biggest one is the debt situation, not just in Europe, but also here in the United States. Once a country's debt to GDP level crosses 90%, growth slows by at least 1% a year until they get that debt situation rectified. We're currently at 100% here in the United States. In Europe, we're over 100% debt to GDP. So we definitely have some serious issues.
So how does that translate into investments outside of the dividend payers? I'm just trying to get some other ideas from you.
Okay. I mean, other investments, as I mentioned earlier, we do like the high-yield bonds. High-yield bonds have actually outperformed stocks since 2009 with significantly less volatility. Right now, the high-yield bonds are, you know, yielding maybe 8+% or so. Great risk-adjusted returns for our clients, and corporate balance sheets are cash-rich. So, yeah, I think based on where yields are, we're probably pricing in about an 8 to 10% default rate. However, I think it's going to be closer to 3 to 4%.
Okay, Mark. Thanks so much for your time and your insights and some of your investment ideas. Mark Tepper.
Thanks for having me.